This Week in Economics from WBRN Radio and on the Bostonred Network. The date of our episode is the 18th of August, 2019. We'll be in this episode looking at the Dow, the yield curve, or what's called inverse yield curve. And we'll also look at farm income. We'll spend some time on it and some time on the markets. Looking at Reuters here, a post that was done on the 14th, a fairly recent post here, and try to get some opinions here. This happened on Wednesday. Sold off, the market sold off as recession fears have gripped the market after the Treasury yield temporarily inverted for the first time in 12 years. Now, this is very interesting in itself. All three major U.S. indexes closed down about 3%, with blue chip Dow posting its biggest one-day drop since October after the 2-year Treasury yield surpassed those of the 10-year bond, which is considered a classic recession signal. Dire economic data from China and Germany suggested a flattering of global economy, stricken by increasing belligerent trade talks. Brexit, we'll talk about Brexit also, and geopolitical tensions, less geopolitical tensions than that. In Germany, of course, reported a contraction in the second quarter. Gross domestic product and China's industrial growth hit a 17-year low. It was all negative, not much positive news. That is from Horizon Investments in Hammond, Ohio, outside of Chicago. Chuck Carlson there. We're outside of the earnings season, and markets are being battered around by news. It's a reactionary market right now, and probably will continue to be. My guess is we'll probably be in for this until after Labor Day. Now, on Wednesday, this is we talked about inverted yield curves here before. And for the first time, that the yields for the 2-year and 10-year Treasury inverted since June of 2007. That was the start of the Depression. Months before the onset of the Depression, which crippled the market for years. The yield curve has inverted before every recession, in the last 50 years. It could be different this time when you got $15 trillion in global government debt and a negative yield. That's the new annal. No doubt about that. When you talk about that, even if it is accurate in foreshadowing a recession, that doesn't mean it's coming tomorrow. Now, that's the very big question there as to when you have a recession. The standard definition for recession is a basic decline in 2 consecutive quarters. Now, pose the question there, is there a modern day definition? Well, we looked at that in the Depression, what they want to call the Great Recession. We won't quibble here on semantics. But for this generation, post-30s, it was a depression, no doubt about it. And then, of course, there was a Great Depression, a different situation, much smaller economy. Now, the CBO Volatility Index, a gauge of investor anxiety, jumped 4.58 to 22.10. The Dow Jones average fell at 849 points, or 3.05, to 1,479.42. The S&P 500 lost 85.72 points, or 2.93%, to 2,840.6. The Nasdaq Composite dropped at the same time 242 points to 0.42 or 3.02 there. Now, one thing to always remember about markets themselves being creatures of capitalism, particularly modern day capitalism, there can be many things going there that, in other words, the market can go up and down. We use what's called a seesaw model. The market has seesawed. And today the market is in a much better shape as far as numbers, and we'll get to that later here. But the numbers, what do they mean? It's sort of like if you look at the commodities market, we will take a look at it. Gasoline prices across the U.S. all-time low, below $2.50 per gallon for the gasoline of petrol. Now those are down, but at the same time, other things are up. There are. I was talking to a lady that worked at a hotel, and they had a lot of vacancies, and thus she was getting off early. So this is sort of a little anecdotal information there. Over 300 of the S&P's 500 composite are down 10% or more for the 52-week highs. That's according to RFNF data. More than 180 of these stocks have fallen more than 20% over the year 52-week average. All of the 11 major sectors in the S&P 500 closed in negative territory: energy, financial materials, consumer discretion, communication services. They all fell 3% or more. Interest rate sensitive banks tumbled 4.3%. Macy's shares plunged 13.2% after the store missed the quarterly profit estimates, cuts their full earnings estimate, full year earnings estimate. Nordstrom and Kohl's slid 10.6 and 11 respectively. Not unusual there at all. These are from the pharmaceutical industries. Mylan fell 8.5%. The rival U.S. listed Telver slipped 10.5%. Facebook slid 4.6% on news, and the European Union is investigating how they manage consumer data there, doing the manual transcription of users' audio recordings. Declining issues, and we won't get into that, what they outnumbered, but volume on the exchange was 8.68 billion, and so forth and so on. And we don't pay as much as much attention to, but what early morning. What we do see here is a market in a decline until Labor Day. But what happens after Labor Day? Now, from a political perspective, much has been written about the economy and the present administration's promotion of it over their first 2-year period. But one thing to remember is the artificiality of the basic economy, the basic structured economy. Huge tax cut there, over $1 trillion. Those are things in the old days used to be called pump priming, that you use during a recession. You don't use it during quote-unquote a normal economic phase. And that was used, and many other things, subsidies in a farming industry. And we'll look at the state of the farm from our friends at Creighton University in Nebraska. We'll spend some time on that this particular episode when we really look at things. But also the tech sector has been hurt. We'll go to Cisco earnings here, and this is their earnings. This is from CNBC. They fell as much as 7%. That was also on Wednesday, reported weaker than expected guidance there. Also dropped. It dropped 4% during a disastrous day there, and where their revenue was pretty close here, 13.43 billion versus 13.38 billion, and analysts expect that revenue grew 6%. That's an atomized basis there. We did see in July some slightly early indicators of some major macro shifts that we couldn't see in the prior quarter. That is from CEO Robbins that told in analyst conference. He said the quarter Cisco company saw a slight impact on business in China because of the trade war. In China, Cisco revenue fell 25%. That's to be expected there. The majority of revenue comes from sales of data center networking products, including switches and routers. That business is represented by Cisco's infrastructure platform segment, which came up with recorded revenue of 7.88 billion, above 7.84 consensus poll. This is FactSet. Many of these new operations here, the application segment, had 1.49 billion in revenue, in line with FactSet's analysis consensus. Cisco's security business contributed 714 million in revenue, less than the 739.9 million of the consensus estimate. This again from FactSet. Some analysts expressed concern about Cisco's strong hardware company NetApp decision to lower its financial guidance there. It was something we didn't know. NetApp used to be a reseller for NetApp. There, a large portion of NetApp's headwinds, they have a limited impact on Cisco, except for large accounts, which you believe Cisco is well positioned to offset through a strong product cycle and broader consumer exposure. That's from J.D. Morgan analyst wrote in a note. So you have some consolidation there. Cisco's a broad customer base could help the company weather soft macro conditions. That's again from J.P. Morgan, who have an overweight rating on Cisco. Cisco announced new Wi-Fi products, a plan to acquire another communications company. I've not heard of these people before. Acacia Communications, I hope that's how you pronounce it. Cisco said it expects 80 to 82% in earnings per share. Shares of the company are up 17% since the beginning of the year. Now, how long that can last, be a very interesting situation as data centers, where data centers are going, consumer products, dealing with Wi-Fi, and particularly 5G was the reason we looked at this particular segment. We'll have Jackson Hole, and we'll be talking about Jackson Hole, I believe, in the next episode that we have here next this week in economics. We'll out of Jackson Hole, Wyoming, something that will be happening there. And let me just oops. Now this is more from CNBC here. On the TIF, a little bit more dated there. But again, farmers are lost their fourth quarter's largest export market after China officially canceled all purchases there, and China's exit piles on to a devastating year for farmers. who is struggling from record floods. Now this is and droughts that destroyed crop from some farmer here in North Dakota, 35 years. He said it's really getting bad out there. There's no incentive to keep farming except that I invested everything I had in farming. U.S. Farmers lost one of their biggest customers in China, and this is around the 10% tariffs which will kick in. And as one said, the Trump administration is ruining their markets. No one is buying our products no more, and we have no markets no more. Very interesting situation there. America agriculture exports to China dropped more than half last year. In 2017, China imported 19.5 billion agricultural goods, making it the second largest buyer overall for American farmers. That dropped to 9.2 billion as in 2018. This year, China's agricultural imports are down roughly 20%. U.S. grain, dairy, and livestock farmers have seen their revenue evaporate. As a result, over the last 6 years, farm income has dropped 45% from 123.4 billion in 2013 to 63 billion last year, according to USDA. This Kylam here, who has roughly 1,500 acres of wheat and sunflower, lost $70 per acre this year despite growing good crops. Current government subsidies only cover $15 per acre. There's no incentive to keep farming. Well, we already went over this. And from Zippy, that's an interesting name. He's the president of the American Farm Bureau Federation. Said China's exit is a body blow to thousands of farmers and ranchers. China is the top buyer of soybeans. They're buying about 60%. Their analyst estimates soybean prices have dropped 9% since the beginning of the so-called trade war. Soybean exports to China dropped by 75% from September of 2018 to May of 2019, compared to the same 9-month period in 18 and 17 there. It's killing us, according to another farmer. He said he lost $3 per bushel of soybeans he planted. That's in North Dakota. The U.S. currently leverages 25% tariffs on $250 billion in Chinese goods, while Chinese tariffs on American imports are currently at $110 billion. China will also consider imposing tariffs on agricultural products that's already purchased. Now, in May, the administration rolled out a $16 billion farm aid package for farmers. On Tuesday, a day after the announcement, they promised farmers that China had mounted an attack on the U.S. farm sector won't hurt them, promised more aid in 2020. Of course, it begs what is going on here. Now, the 2,300 counties that voted for Trump in 2016 have received money from the bailout program, and those counties that flipped voting from Barack Obama in 2012 to Trump are most likely to get money than counties that were red during both elections. That's according to the Environmental Working Group. That's from the Washington Post. Some farmers say the billions in bailouts and rounds of subsidies they received thus far have failed to cover the loss in profits. I'm happy for the $16 trillion, but I'd much rather get it from the marketplace. Well, that is something that will not happen now. Alan Williams, who farmed for 50 years in Illinois, said the trade war benefits no one, and government subsidies are on just expense for taxpayers. Subsidies have covered 8% of his gross revenue this year. It's not a lot, but I suppose out there. The overall approval rating here is 79% amongst farmers. This is for the present administration. And a high record of farmers, some 78%, said the trade war will benefit U.S. agriculture. That's according to a July survey from Purdue Center for Commercial Agriculture. More than 75% of rural farmers voted for DJ Trump. A grain farmer from Iowa, this is Mike Nipper, who likes some of the policy, dislikes others, said that most farmers in his community support the administration. It doesn't matter who's president. People like DJ Trump and will support him. Okay, anyone wanting to see through and those government subsidy checks might help him get by another year. People say the problems have enough to do with Trump. Don't complain to me how bad you're doing, and support the person who's put you in out there. That is frustrating. Now, no doubt about that. A lot of frustration going on with some of the farmers in farmland. Let's do our little survey here. Where is it? We'll have to find it. It is hiding somewhere here. And here we are. Now, this is a monthly survey of Community Bank Main Street report here. Does the U.S. Fed rate debt really matter? Interest rates fall as debt load soars. Three of the biggest global economies, U.S., China, and Japan, currently have federal debt loads as a percentage of domestic product at 108%. And 249% and 236% respectively. At the same time, interest rates on long-term bonds of each of these three global powers are in the U.S. at 2.1 and 3.1 in China, and negative interest rates, negative 0.1% in Japan. We economists teach our classes that as governments compete with consumers and businesses for investment dollars, interest rates rise. Are our models wrong, or we lost relevance there? Nothing. Noting, the seemingly disconnect between public debt and interest rates. Several candidates have called for passage of massive spending. They had the Green New Deal and Medicare for all. That's from Representative Alexandria Ocasio-Cortez. And there's a lot of commentary here. Too young to run for president, but too old to remember anything from Boston University economic classes. Argues that 40 trillion GDP has been paid for with 8 trillion in taxes on the wealth. It could be paid for that. G&D could pay for the 8 trillion in. She implies that the other 32 trillion would come from debt and dollar printing presses. Again, no recognition link between the size of debt and interest rates. You look to Greece for economic parallels. That's not a very good one there. Over the past 200 years, Greece has reneged 7 times on repayment of its national debt. In 2017, remember that Greece once again teetered on default, but by agreeing to austerity measures, which usually do not work very well. The U.S. dollar is and will continue to be a global reserve currency. That is a little bit of fiction. That means that foreign investors remain willing to lend to the U.S. despite heavy debt load, current rock bottom interest rates. Second, the U.S. Federal Reserve stands ready to buy U.S. bonds regardless of the size of the debt. The Fed's actions boost the money supply, increasing inflationary pressures, and reduces the size of inflation-adjusted debt. Third, the U.S. Treasury could always open to pay interest and principals of maturing there. I'm not how we go there. Now, this is Creighton University's main Rural Main Street Index for July rose above the neutral for the month, according to the 10-month survey of bank CEOs in rural areas of a 10 region, depending on agriculture and energy. There overall, the index climbed, as is most indexes, to 53.2 from 48.5 in May. This is the sixth time in the past 7 months that the index has risen above the neutral. The index ranged between 0 and 100, with 50 representing growth neutral, and the RMI below that threshold indicates negative growth there. So it had some growth. Higher economic commodity prices and rebuilding from recent floods and rural Main Street index for the month. Furthermore, despite negatives from the trade war, 69.4% of bankers support either raising or continuing current tariffs. Very interesting summary they come to there. Jeff Bunnett, he's at Hanover Bank in Hanover, Illinois, some small town, estimated that anywhere from 15 to 20 million acres were not planted in corn. According to him, based on his information, corn prices should be in the range of $5.75 to $6 a bushel there. So again, that is that. Farming and ranching price index for June improved to a still a weak 44.8 from May's 41.2. This is July. We'll look at a little more of it. Banking. Borrowing by farmers for June remained very strong. That index fell to 72.6 from May's 79.7, and April's record of 81.3. Check depositing index to 50 from 42.4, while the index for certificates of deposit and other saving instruments rose slightly there at 51.6 from 51.5 in May. The employment gauge climbed to a strong 64.5 from May's 61.8, despite floods, tariffs, and so forth. Main Street business continues to hire at a solid pace. Overall, 12 months, Main Street economy added jobs at the rate of 0.2% compared to 1.3% in urban areas. For the same 10 states, rural areas in 4 of the rural Main Street states, Iowa, Missouri, Nebraska, and Illinois, lost jobs over the past 12 months. Confidence. The confidence index, which reflects bank CEOs' expectations for the economy, 6 months out, expanded to 53.3 in May, from a dismal 38.2, indicating a positive but somewhat weak economic outlook amongst bankers. Home and retail sales. Home sales increased to a very strong 69.4 in May, from May's healthy 63.2. Retail sales index for June advanced to a healthy 58.1 from May's 44.1. It appears that the region is experiencing a rebound from recent low retail sales resulting from floods and other problems. Each month, community bank presidents in non-urban agriculture and energy-dependent portions of 10 states are surveyed on their economic conditions and their projections 6 months down. Bankers from Colorado, Illinois, Iowa, Kansas, Minnesota, Missouri, Nebraska, North and South Dakota, and Wyoming are included. The survey representatives are snapshot there of the Rural Main Street Index. And what the 200 communities there with an average population of just 1,300. We first go to Colorado. We like to dig a little deep there. Rose from 54.2 from 49.6 in May. The Farmland Ranch Price Index rose to 45 from 41. Colorado's hiring index for June climbed to 70.7 from 61.3. Land values are up because of demand for hemp. Now, this is very interesting. Crops that were universally condemned at one time, hemp and marijuana production in the state of Colorado. In Illinois, the June index increased from 51 to, increased to 51 from 46.3. Farmland prices rose to 41.1 from 40.5. The state's new hiring index fell to 49.5 from 52.7. Somebody at Anchor State Bank in Anchor, Illinois reported planting is mostly complete in our area, but areas in north and south are significantly down. Let's go back up here and catch some of these other states. Iowa. That index is very important because of Iowa in the primary is 51.1 from 46.5. The farm price index shrunk to 41.1 from 47.2. Iowa's new hiring index for June slumped to 48.9 from 51.1 in May. That's according to James Brown, the Harding County Savings Bank there. If our farmers take advantage of improved corn prices, it would be much better year for our customers. That will certainly vary in the region. In Kansas, it climbed to 51.6 from May's 48.9. The state's farmland price index grew to 44.3 from 40.7 in May. The hiring index in Kansas advanced to 56.8 from 54.4. Kansas has historically had a higher employment index there. In June, in Minnesota, it climbed to 53.8 from 52.3. Minnesota farmland prices rose from 44.8 to 44.8 temps from 41.2 temps in May. New hiring index expanded at 68.9 from May's 60.6. The state bank in Albert Lea reported that our Pacific area within 30-mile radius did not experience the spring rains and all crops are planted, and in 80% in good condition there. In Missouri, it climbed to their index climbed to 48 from 43.3 temps in May. The farmland index for the state increased at 43.3 from May's 39.7. The new hire index in Missouri in June rose to 47.1 from May's 44.7 in Nebraska. It rose to 50 in Nebraska from 45.9 in May. The farmland price index increased to 44 from last month's 40.4. Nebraska's new hiring index declined to 49.5 from 51.5 in North Dakota. The index was at 55.7 from May's 51. Farmland there at 45.4 from 41.7 temps in May. The new hire index in Nebraska 67.7 from 65.2 temps. The Dakotas in South Dakota let's see, climbed to 54.9 from 50 in May. The state's farmland price index, the lower farm prices there, farmland price I should say, improved to 45.1 from May's 41.5. South Dakota's new higher index advanced to 65.4 from 63 in May. And finally, Wyoming expanded to 55.4 from May's 50.7. Farmland ranch land price index rose to 45.3 from 41.6. Wyoming new higher index at 66.8 from 64. Bullish news. Oh, this is U.S. Expansion here. What happened in June? They don't have what happened later than that. The overall employment, of course, this is in the nation at 3.7, 3.8, 3.9. Doesn't really mean a lot. Let's look at some market numbers now. We do a little more exploration here. Okay, we're pretty much on target here. I think the FTSE, let's see what's happened with the FTSE here. At 0.71%, Nikkei at 0.06% there, and the HSI at 0.49% there. I guess we can get the changes here in it. The FTSE at 50.14 would do it like Nikkei at 13.16 to 38.76 in Shanghai. The VEC at negative 2.71. The DAC at 150.7. That is where they are. And if we look at the yields here, kind of interesting here. The 10-year is at 1.562. The 30-year at 2.044. The 5-year at 1.423. And the 2-year actually is at 1.486. And you can see where that is going. And we even have a free month here at 1.871. And the Japanese 10-year is at not a negative, not 0.237 in the negative there. And look at a few more markets here in Bolivia. What they're at 7.48. Excuse me, 748.87. In Caracas, actually, they're at 511.61. Surprised at that one. Given some of the European markets here, this, the CAC that's in France at 63.86. In Spain, they're at 7.10. I believe this. Let's see who else we missed. We got the CAC. We got did we get the FTSE at 50.41? In the Korean Republic, negative 11.20 there. And some of them we're just looking at in Malaysia. I guess we'll do them. A negative 1.07 in Taiwan. Taiwan 93.76. And this is from CNBC, incidentally. A little note here, Japan surpasses China as the largest foreign holder of U.S. treasuries. Chinese are trying to get plague themselves of U.S. treasuries. And let me go back up a little bit here as we get these figures in. We try to switch it around a little bit here, and we'll get into we unfortunately don't have Brent crude in today, but at 54.94. That's where oil is, and natural gas. Gold is down at $1,523.60. Wheat is up by $1.25. And Ray Dallo says there's a 40% chance of a U.S. recession before the election. Well, very interesting there. What he has to say on that issue. And I don't think, just getting some of these little side notes here and looking at them as CNBC, we see the, excuse me, the recession card playing here, and bear market fears could return very, very quickly. That's from Jim Paulson. And from Cisco, Apple, and IBM are leading the Dow this year, but only two look good, according to two people. Yeah, there is a problem in terms of expansion there. There's obviously no doubt about that. So thus this week, a mixed economy out here. Huge losses on Wall Street, and some recouping there. You're going to see that sort of up and down motion going along, and part of the problem is from our rural look there, the market is not strong enough to sustain itself. Now, this bond buying, quantitative easing coming back. We heard during past years of the Obama administration talk of abandoning quantitative easing, accommodative policy. Now it's coming back. What that shows is the economy is basically weak. I don't want to call it a Trojan horse, but at the same time, the fundamentals is not as good as some analysts would try to project it. And this is one of the things the market can do. Investors can buy stocks, thus improving the market. Or they start to look at present-day global economic situations and problems. It's sort of like in some of the emerging markets now. Looking at Zimbabwe, for instance, the economy is in shambles, has not improved under Mr. Mugabe since his replacement of the long-standing Robert Mugabe. It hasn't appeared that way. Still, their fundamental problems are there. High inflation, lack of consumer products, governance, etc. And those are some of the things that are coming up that we have to look at. And we'll look at China, where China is. There are competing calls out there that in the long term, this tariff regime and various other problems will benefit China. Now, we got from the people at Creighton University that the impact on American agriculture will actually strengthen American agriculture. Well, that's a possibility, but in the near term, not. And one has to understand the dynamics here. You have the dynamics of the global economy that is not advantageous to American agriculture, but at the same time you have the climate component. That is droughts and floods, and that has across several areas now. This 10 state area that Creighton University covers, but also we look at information out of New Orleans and the oyster crop down there because of the fresh water flooding from the Mississippi, and that crop is almost lost for the year. So you're gonna have those kinds of problems that will impact. So you're getting climate problems there from climate change, no doubt about that, is starting to impact, and of course we put that in our model. and at the same time, you have a lessening of world demand out there, and of course Japan with negative interest rates. The other central banks have all cut their interest rates down, and basically Brexit, a no-deal Brexit, a paper that came out called Yellowhammer. The UK economy would be short of basic things says foodstuffs there, medicines, that thing could be short. There's some stockpiling there that contributes to that. But again, this is a politically imposed crisis in the UK with leaving the UK, and if they have a hard Brexit, that will impact the UK and the EU. And the German economies, its contraction, they have the MEC things, economy, that in itself, manufacturing, of course, manufacturing being weak also in the U.S. I had the recent manufacturing here that came out the other day. I'm not sure where it is. Let me just take a station break here, WBRN Radio. Hold on just a minute. For those in business, make next week a productive one, and the consumer, the eye is on the prize. We'll look to Jackson Hole and try to make some further sense out of this. The report we were looking at was U.S. manufacturing. It was weak indeed. We don't have it. We'll have to throw it in on the next this week in economics and do a little better job of housekeeping around here on the numbers man sector. Good day.